Welcome to the May Wealth Advisory Review. And once again, we are doing a few new things with the podcast and what we're trying to bring to you. So hopefully tonight you will get to see a few new things that we're doing with the cameras and also the materials as well. Hopefully also you've been able to go to the website and see we have the March web advisory review loaded up there so you can see it and see how that's been going. And then we have the April right behind it. And with our video editor, she's doing a fantastic job. And we're looking forward to having the May review loaded up quickly so that within the next 2 weeks, you'll be able to see that as well. Now, on to the podcast, the program itself. It's going to be a jam-packed program. I spent, I would say, close to 10 hours editing everything together to put together the presentation, the materials I wanted to review with you tonight, because a lot has happened in the last 30 days since we last spoke. Matter of fact, in the last 2 weeks, a lot has happened. And so normally I have about 28 to 30 slides I run through tonight. I'm going to go through about 40 slides. I don't think it's going to take any longer than normal because some of them are just going to be more quick as just a way to get a feel for what's going on. But we have a lot to cover tonight, and so I'm going to get started with that so that you can take a look at what we have here. As always, we have the disclosures that are just a reminder to you that everything you look at and see on the podcast is for information purposes only. If we talk about investment strategies, my encouragement always is the same. Make sure this makes sense for you. If we talk about legal items, talk with your attorney, or accounting items, talk with your CPA to make sure that everything that we're discussing here fits well in your situation. Because you're unique, just like all of your friends are unique, and every situation deserves to have an answer that's specifically for your needs, your wants, and your desires. We'll have time at the end for questions where you can ask questions either by raising your hand and typing in the question in the chat, or in some cases, if the muting works for you, we'll be able to let you speak the question. We can talk directly about it. Tonight, we're going to talk a little bit more about Trump presidency 1.0 and 2.0 as a refresher from last Wealth Advisory Review to this one. And then we're going to talk about reasons why the market may fall further. And we're going to talk about the market issues with sector rotation and portfolio management. And then we're going to talk about reasons why the market may actually be in a V-shaped recovery, to give you both sides of this story so that you can understand how this works for you, and then maybe even be able to understand a little more about how we're handling things from our side. We're going to talk about bad markets and economies and how that is essential for your planning needs. And as well as that, wealth management for you and your family, the Frank Reynolds & Company differences and the materials we use to help you manage wealth wisely, and upcoming events we have for you. So let's go ahead and get started. You may remember that in last month, I talked about the Trump presidency 1.0, and I used this slide here. I actually used several slides to get from that discussion to where this slide is. But just kind of a quick sort of primer on this is that what I would suggest to you is this, is that if we take from the beginning of President Trump's first presidency in 2017, January 2017, and we take it out to about 6 months after he left office, the return that investors experienced on the S&P 500 was 87%, almost doubling in that 4.5 year time frame. But during that time, we had two 10% corrections, and we had two 20% bear markets. So you can see on the chart here, a 6-month correction that started in May of 2018, and then it peaked out, got back into shape again, and then in November 2018 through probably June of 2019 had it happen again. That was actually a 20% bear market that we experienced for that 6-month period of time. Did pretty good for a while, had some minor pullbacks and so on, but basically went up until we got into the pandemic, 2020, February, March, had a significant drop, but a V-shaped recovery, something that President Trump kept saying was going to happen. Most people around him said it was not going to happen, but it turned out to happen. We had a V-shaped recovery. Within 6 months, we were right back up to where we were before. Had a little bit of a pullback again. 10 weeks, we had another correction, and then took off again. One of the things that I try to use this slide to remind people of is that President Trump is He's volatile. He is a disruptor. He changes conversations. And he seems to do so with a plan. And oftentimes it seems perilous when it's happening. And these tariff discussions are no different this time around. When President Trump was working through all those processes last time, and it did work out in the end, it was surprising to many people. Many people in my industry were surprised how well the economy performed. I think a lot of politicians were surprised how well the economy performed. But the reality is feels kind of like we're doing it again, a different version of the same situation. The point on this slide right here is there are no guarantees that the outcome of the second presidency for President Trump will compare favorably as the first presidency did. But we have to recognize that there is a lot of disruption that's happening, a lot of discussions that are happening, a lot of change that's happening, and hopefully those will work out well. That's why I do these monthly advisory reviews, to let you know what we see happening, not just with President Trump, but with President Biden before him and with others, that we think there are times that clients need to see information that can help them either stabilize what they're doing, feel good about their decisions, or make new decisions going forward. Another thing that I shared with you in the last slide, or the last review, were that the Mag 7, at that time, they were at their lowest. They're not anymore. They actually have regained quite handsomely. But the Mag 7, which would be the Netflix, the Google, the Apple, Tesla, NVIDIA, those sorts of things, they have returned quite nicely. That also was due, quite honestly, to the the discussions about tariffs back in 2018. Well, that has represented itself again this time around. That's same players, China and the U.S. in 2018, worked through that process, did it this time a little bit harder and a little bit more heavy. But what I did express to you was this, that the market really kind of started to fall in 2024. And it happened as a result of China's AI called DeepSeek. And it really began to shake up the informational technology world. It began to shake up AI, because what China had put together, at least the way the reports came out, was something that was as successful or more so and much cheaper. And so when everybody began looking at that, it really caused a bit of a panic among the Magnificent Seven, among AI, among information and technology. And so that's where that started. And then on April 2nd, when we had Liberation Day, President Trump came out and talked about the tariffs, the reciprocal tariffs, how big they were going to be, how bad they were going to be. And that's where the market really plummeted at that point. Since that time, it's actually come back up quite nicely. We're going to take a look at that here in a few minutes. But it has been a tumultuous couple of weeks, this last 2 weeks. And if you go back to February 19th, more than a month, it's been a lot going on. If you follow the news, you know what I'm talking about. If you don't, well, you're going to find out a few pieces tonight then. One of the things I thought I'd also show would be the information about the tariffs, because I think that, most people don't really understand what the tariffs actually mean. I spent a fair amount of time last month identifying what the tariffs were about, how tariffs have been used in the past, when it was successful, and why it might work this time. This slide, though, shows you about the trade imbalance that exists. You can see here on the bottom group, we have those that we have trade surplus with: the Netherlands and Hong Kong, Australia, the UK. We have trade surpluses with them. And then at the top, you can see who we have trade deficits with: China, Mexico, Vietnam, and Ireland. Significant trade imbalances. And not just from the lost revenue that we get, not just from, and I'm talking about taxes in that sense, but also the lost revenue that American corporations are losing. I heard President Trump say it in the presentation, or the message he did the other day, that Europe sells a lot of cars in America. All you got to do is look around at all the BMWs and Mercedes. You can see all those cars that are being sold here, Volvos and Saabs and such. But we hardly sell any cars in Europe. And that's a trade imbalance where American companies could be making money there. And that imbalance can be fixed. And that's part of what President Trump is attempting to do, to make this so that it's not so red and more fair and unilateral for everybody. We want China to win as much as we want the U.S. to win. And I think that's what's being said here, even though sometimes it seems like it's being distorted a bit. But that's really what this is about, in my opinion. And I think that if you follow the news, you realize that we already have a new trade agreement in place with the United Kingdom, and China is on a pause for 90 days, which seems to be a very good step in that direction. Also, turning on some of the transport of containers and ships from China to the U.S. and to Europe will also help with a lot of issues that I think are concerning people. So when we talk about tariffs and trade imbalances and so on, hopefully you'll remember this slide and you'll realize this is what this is really about, is to not hurt the world or hurt the U.S. or hurt other countries, but rather to make a balanced and fair trade play for the U.S. versus the countries and our other trading partners. So with that information and the big changeover that's happened in the last few weeks, and you can see here on this chart, this is the S&P 500. Right here is the February 19th when the market went down. Primarily, we had a lot of issues that I think was really that start of DeepSeek. Then we had the Liberation Day with all the tariff announcements. And this is where it sank to the bottom here and it came back up. And then in the last week, it has just gapped up on 2 or 3 occasions. And by gapping, I mean that it closes one day and the next day it's even higher than it was before. It created a gap. And the market is uncomfortable with gaps. It tries to fill them. And so when we're looking at this, these are pieces that from a technical viewpoint, we look at to say, is this going to be a problem on the other side of this discussion? Having said that, you can see here on the chart that what we're looking at is a possibility that it could go up or it could go down. And that's what I want to talk about tonight is what are the items that we should be looking for as far as if it goes down, are we in trouble? Is it a big deal? Are we looking at a reset like 2008 or 2001? Or would this be more of just a rebalance and then a takeoff again? Or will it just continue from this level right here and just take off and create that V-shaped recovery? So let's take a look and drill down into that a bit. Now, when it comes to the markets and how they behave, and especially in this sort of up behavior, usually it's the institutions that are leading this discussion. Usually it's the institutions who are buying in, and the retail investors are not ready yet because they're concerned about news or they're concerned about rumors, and so they wait until they see other things happening. This time, it's completely different. As a matter of fact, on this chart, you can see 3 groups of investors. There's hedge funds, there's institutional investors, and there's retail investors. And the institutional investors, you can see they still have not started buying in. They've been selling more than they buy. And hedge funds have been selling even more than they were buying in. But retail clients, they have led the rally that we're in right now. Retail clients are the ones who are buying into it. I talked with a client today, and it was yesterday. The answer the client had was, I don't know exactly how it's going to work out with President Trump, but I think he's on the right track, and so we want to get in. And I said, fine, I think that's a great idea. But that doesn't mean that just because it's going to go up, it's going to just shoot up and keep going up. We think that there's going to be some volatility in there. That volatility is going to represent some buying opportunities. So rather than buy everything in all at once, our recommendation at this moment is to buy in pieces of it. As a matter of fact, we started doing some of that this week with clients' accounts. We had a fair amount of cash that we had set aside for clients, and we began buying in this week to several positions that we think are going to be really valuable as we go forward through this next year and maybe even in next year. And we're not buying it all in, though, because we want to save some if there's some pullbacks or some volatility, much like I showed you on that slide in President Trump's first presidency, where you had pullbacks, corrections, and even bear markets. Those represent opportunities. If you've got resources set aside for those moments, you can buy things on sale. I mean, if you think about that for a moment, it's really pretty easy. If you go shopping, do you want to buy things at full price? Would you like to buy them at 10% off? Or would you like to buy them at 20% off? And by having that opportunity, having resources set aside for it, that's part of how we make this work to get a great opportunity coming up. So right now, it's obvious that retail investors are leading the way. Institutional and hedge fund investors are not leading the way right now. Hopefully, they're going to join in, because if you have all 3 buying in, it's going to be Katie bar the door. Now, having said all that, you have this article. This was from May 9th. Why this stock market bounce won't hold. That's the Wall Street Journal. I don't know if you read the Wall Street Journal, but when the Wall Street Journal says, oh, this stock market bounce is not going to hold, matter of fact, you can read in the subheading, after Liberation Day, stocks fell a lot, perhaps too much. They have now rebounded a lot, perhaps too much. And so it's this concern that there's another shoe to drop out there. And what might that be? And that's why I want to take some time to talk about why the market might not go up or it might fall further and what that would mean for us. One of the things that's a big concern, I don't know if you follow the news closely, but if you have lately, there's been some discussion about the U.S. bond market, U.S. bonds, treasuries, and the willingness of foreign investors to buy U.S. treasuries, whether or not the interest that the U.S. treasuries are paying is high enough or might have to raise it higher to catch people's interest, whether or not the credit worthiness of the U.S. treasuries and our U.S. debt is such that people are concerned about it. These are all issues that people are watching carefully. But one of those issues with all of that tied together is right here. And what you see is that there is about $7 trillion of U.S. treasuries that are going to mature this year. And that means the U.S. government has to refinance those. They have to resell those bonds. They have to find new investors who are willing to buy them. They have to decide what interest rates they're going to pay on those. And so when they pay off those bonds, and what that means is if you hold a U.S. treasury, they're going to give you your money back. But they need that money because we have debt. And so when they refinance that debt and they give you your money back, they have to sell another bond to offset it. Well, what if they can't find somebody to buy $7 trillion? What if credit worthiness is a problem in the U.S.? What if the interest rates are too high? These are all issues that people are concerned about. And that is a big reason, because if the bond market gets messy, then so could the stock market. And so this $7 trillion of maturity of debt, this wall is huge. As a matter of fact, you can see last year it wasn't this big. No year in the next 2 to 3 decades is this big. So this is a huge issue. Now, do I think it's going to work out? I do. I think that some of the things that we've been seeing from President Trump, from U.S. Treasury Secretary Scott Bessent, as well as others in his cabinet, it looks like it is going to work out. But there's a lot to happen between now and the next few months, the next quarter or 2 quarters, as to whether or not this will work out well, or will there be more issues? What happens if one of the Treasury auctions doesn't come off well? What happens if it doesn't sell all the bonds? I can tell you that will be a huge deal that the media will be pointing at a lot, and that will create concern, and that could then drive the markets back down. So this is one of those things that is something to keep our eyes on to make sure that we're ready in case something happens. And even if it's just rumor, not news or fact, but more rumor, it still can have an impact. But being ready for that as one piece of this discussion is essential. So another issue that we've been looking at is how CEOs and corporate calls about earnings are going. And so one of the things we've had here, this has to do with the number of S&P 500 firms mentioning recession during earning quarterly calls. The quarterly earning calls, I'm sorry. So first quarter of 2020, 36% of the calls talked about recession. In 2022, where we had a correction, the market went down about 25% in 2022. It was 38% mentioned it. And this first quarter, with all of this just starting, 23% mentioned it. As a matter of fact, we had negative GDP. At least that's what the current numbers look like for Q1. And so these pieces cause firms to talk about, are we going to be facing recession? What does that mean as far as how we're going to grow the business, how we're going to handle financing in the future, how we're going to handle employees over here on layoffs? The number of S&P 500 companies mentioning layoffs during their quarterly calls, 2%. Again, 7% in 2022 and 9% in 2020. But again, I'd like to point out, this is just the start of this. If everything works out well, it won't be a problem. But if things become problematic, it could be. And that's another piece why I think a lot of people are concerned about where the economy is going and how that's going to impact corporate profits, and then how that's going to impact the stock market and your family wealth. So when we look at indicators, and I've shown you the sector rotation discussion before, but I decided to pull up a little more information tonight to sort of drill down on that. So I'm going to change from here for a second and go over to, there we go. So there are 4 items we look for when we're trying to identify what kind of shape the economy is in. You know, we talked about technical analytics, which means we're looking at the technicals of a stock or an industry or the economy. In this case, these are the fundamentals about the economy. And so consumer expectations. How comfortable, how confident are consumers that everything's going to be okay, that they're still going to have a job tomorrow, they're still going to be able to take that vacation, they're still going to be able to make their mortgage payment, their rent payment. How comfortable are they? Well, you can tell right here that we're at a pretty low spot. Matter of fact, when we had the bear market in 2022, we were lower there, but we've just fallen off the cliff at this point. And so consumer confidence has taken a big hit, which is interesting because retail investors are investing in the market, and yet consumers say they're concerned about it. Now, not every household is able to invest in 401ks or their personal investment accounts. I understand that. But if the majority of people are saying, I don't know if I'm confident in where our economy is and where our finances are and such, they'll stop buying things. They will stop taking trips. They'll stop going out for dinner until they figure out where they are. And all of those pieces will then have sort of a domino effect that will then make it easier for a correction or a recession to happen. So the first item we look at here, and what we're looking at is in this area, this particular report, are we at full recession, early recovery, full recovery, or early recession? And this data gives a feeling that we could be in early recession. Not a fact, but a concern that we could be. That's the first chart. The second chart, industrial production, what companies make and how they're handling their production. And so what we have here is an interesting chart where, well, this doesn't look like it's down, but you can tell that it is flat. It's bouncing around up here, and there's a question, an attempt to try to figure out, can we still maintain these higher levels, or like 2020, will we have a real problem with production? Will we be able to create goods and then transport those goods to retail shops so people can buy them? And right now, and since 2023, we had this again was that blip there where it went down. Well, we're obviously at a high, but will it turn down further? And so I think this really kind of identifies an issue of either we're in that early recession, a falling, or we could be maybe bottoming out, and we actually have had a full recession, but we have not had a recession yet. There's the primary indicators are 2 negative quarters of GDP. We haven't had that yet, but we did have one, Q1. Doesn't look like Q2 is going to be that, but again, I think until just the last couple of days when we had the UK deal and the China deal, or at least the pause for tariffs was put in place, I think that people were really more nervous, and maybe now they might be feeling a little bit better. We'll see. So industrial production, that's the second item we look for to help us determine, are we headed for a problem or not? Third area, interest rates. And interest rates, you know that they have been fairly low at times. Now they're up here in this area, and they had peaked. And you can tell this because all of the tops are a little lower than they were before. And you can tell that the bottoms, they're kind of a little higher. And so they're moving into this place where it's tightening up. And sooner or later, when that happens, it's going to then say, we have to break up or break down. Either interest rates are going to rise or they're going to go down. And Jerome Powell, Fed Secretary, does not want to do that, has expressed he doesn't want to lower interest rates yet. Question about whether he'll do it in the June meeting or not, we don't know. But that is another issue with interest rates, looking at those. And having those interest rates lower a bit would make it easier for families to be able to make major purchases, buy houses, cars, etc. Make it easier for companies to be able to do new production ideas, hire new employees, create new routes of distribution. All these pieces together could help, but right now it looks like if interest rates either flatten out or go up, we could be looking at recession. But right now, it's a little concerning, at this point. Last item is the yield curve, and that is the curve of the interest rates on a 10-year versus a 2-year Treasury. Because the 10-year is a longer Treasury, you expect it to have a higher rate, and you would expect the 2-year to have a lower rate. But when those invert and the 2-year is equal to or higher than the 10-year, that's an expectation that long-term money is really struggling right now, and that the liquidity issues in the economy are more problematic. And so right now, the yield curve's not bad. Could be recession or could be just normal early recovery, but it has risen above the zero line, which is what we're looking for. But you'll notice here for the last couple of years, we've actually been in an inverted yield curve which has been another reason that many professionals think, oh, we got a recession around the corner, which we may still have a recession around the corner, but whether or not it happens this year or next year may be what the real issue is. We'll talk more about that probably in a future advisory review to kind of help you think through that process. So we've got the 4 items here: the yield curve, the interest rates, the industrial production, and the consumer expectation. So let's go back now to the presentation. And so when we look at these 4 items, it gives us an opinion on where we are. Now, there's a second piece to this, and this little chart is really interesting because what it does is it takes the 11 different industries and identifies, are we in an improving economy, in a leading layer of the economy, in a weakening economy, or in a lagging economy? And again, I'm going to show you that particular one as well. So this is actually a live chart of that. And what I'm going to do is just show you how these areas, now what these are is these, let's make this a little bigger again. What these are is these are the 11 industries, and you can see which ones are in green, meaning they're a strong economy, which are yellow, warning, which are red, we got a problem. And so if we just animate that, you can watch how the various industries cycle through a process, which is very important to understand. They are going to cycle. That's part of the deal. You're going to have energy cycle, get strong and get weak again. You're going to have information technology, get strong and then get weak again, get strong and then get weak again. That's part of the process. And you can tell that right here at this point in time, we've got a lot of areas that are still in that strength area. And that's due, quite honestly, to the fact that markets have been good for a while. But we do see this reality that they could be changing. They could be actually moving through a leading and then going into a weakening. Now, can this be forestalled? The answer is it can. If there's enough productivity, if the interest rates are right, if tax rates are right, if all these pieces that make an economy function well stay good, then we're going to be okay. If they don't, then we'll probably have to face some sort of a reset within the economy that will then impact the markets, and then it'll impact our portfolios as well. With that in mind, when we take a look at these 11 industries, we got discretionary spending, what you and I spend on, we don't need to, communication services, technology, industrials, materials, energy, staples, healthcare, utilities, financials, and real estate. These are the major industries that make up the S&P 500, the 500 largest companies in America, whether that is those 500 companies or it's smaller companies that are small cap, the Russell 2000 and so on. These companies are what make up the foundation of our gross domestic product and the ability for our economy to function well and for you and I to enjoy many of the benefits that we enjoy. You can tell that over the last couple of weeks here, this is looking back 30 days. So the ones that this 0 line represents the S&P 500, meaning that it was sort of the baseline. And so anything above the S&P 500 did better than the S&P 500. Anything below that did worse than the S&P 500. So some of the things that were doing better, technology was doing better. As a matter of fact, it just ramped up, which is a really good sign. We can see that industrials ramped up. We can see that discretionary spending, people did start spending some money. So even though consumer sentiment's a little bit low, they did spend more money. And we can also see here that utilities, which is typically more defensive, but it still is above, although you'll notice here it just went right below at the end. So maybe people are a little less defensive now. Maybe that's what we just saw here in the last few days. But that doesn't necessarily mean it's all over. It just means that that's part of what we were able to see and then to make a decision on what we're doing. This represents the best of the last, this is the last 3 months, the different banking, the different industries broken down into more unified or more specialized pieces of those industries, those 11 industries. You can tell there's a lot of red on here, but there's also a lot of green on here in the last 30 days. And quite honestly, if I had done this presentation last week, there'd have been a lot more red. So this last couple of days has been very helpful in making this look a lot better than it was before. So what I'm showing you are pieces that we use to look at the economy, fundamentals, industries, and then individual securities. That's how we decide when we should and shouldn't be in. Technical analytics like this help us understand both the fundamentals of the economy and companies and industries, and the technicals help us decide if this is the time to be in. I find it enjoyable, to be honest, that I have clients who call and say, you know, my friend says we should invest now. And I'm like, okay. But what is your friend basing this on? Well, based on, and they'll tell me some answer. That's not wrong. Their friend can be right. But part of the challenge that we have is that we're trying to make sure that we have more winning opportunities rather than losing opportunities. And to be fair, to be very clear, everybody, including Warren Buffett or whoever you think of as a professional investor, has wins and losses. The goal is to have more wins than you do losses. And by doing that, you make your wealth grow and stay on track. And by keeping whatever losses you do have as small as possible, that makes it so it's easier to climb out of those holes. And so this sort of data, this sort of information, we use to try to figure out what's the best place to be for right now to help clients maximize what they need to do. We just reviewed this chart a moment ago and some of the winners on that chart. This is what I was telling you a moment ago about the sector rotation. And on sector rotation, you can see here that this represents the markets, and then the blue represents the economy. And what you'll notice is that the markets are always trying to be ahead of the economy. In essence, we're always trying to figure out where things are going so we can make good decisions, so we can then capitalize on those decisions. So again, the blue line here at this point, area here, you're in full recession, early recovery, full recovery, early recession. And the way you can kind of tell is looking at these industries. If you have, and you can see the cluster right here, consumer staples, utilities, real estate, financials, and somewhat healthcare. This means that we're over in this area right now. So for the market, we might be looking at a bear market. That's what this part's talking about here. But that can get extended. And that's what's really important to understand, is that it's a dynamic discussion every day. It's one of the things I like about what I do, is that every day is different. Every day is changing. But you can see trends, which is part of what we talk about here every month, the trends that we see. And so right now, I would tell you that until a couple of days ago, I really was concerned the trend was leading towards something more dire. But in the last few days, I've started to see some hope that makes me think that what President Trump is doing and the resiliency of the U.S. economy, the exceptionalism of the U.S. economy, may work well in this process. So here's some additional thoughts. Now, I know I've been sort of walking this tightrope of telling you the things to watch out for and the things I'm concerned with. Here's a few more pieces. Right now, you can tell by this chart here, this represents the number of days, the median number of days of inventory held by goods-oriented industries in the S&P 500 to supply the shelves of the grocery stores and the convenience stores and wherever we shop, those items on those shelves. Right now, we have less than 90 days worth of goods. Now, to be fair, we've been building up since 21 and 23. We had quite a bit, and that was good. That's coming back after the pandemic because we had a hard time filling a lot of orders, and you may remember how difficult it was to get some of those things, some of those items that you wanted. Today, we have about 90 days or a little bit less than 90 days left, and there are shipping containers sitting on docks in China. There are shipping containers on boats coming, or they, at least until just yesterday, they were sitting there in the sea, waiting to get permission to leave and start coming to America or Europe to deliver goods, because China is an export economy. They're not a big importer. They don't sell a lot to their own people. They sell to the world. And so if they can't ship those goods that you and I want to buy, and we're not making those goods that we want to buy, that means that in a couple of months, if we don't have those on our shores and in our trucks and on the way to the places where we shop, we won't be able to buy some of those things. And I assure you, the media will talk about that. They'll talk about those empty shelves. And when they talk about the empty shelves, it'll cause more concerns about recession. It'll cause more concerns about inflation. Those are items that will impact the markets. And this is another one of the reasons I think that a lot of people have been concerned about what could happen if we were to shut off that pipeline between us and China, or if on any of the exporting that we do, if there are problems for us to get materials out to people. These are all items I think have been a big part of this discussion. So now, back to that same slide again. Where are we? Are we headed down or are we headed up? Well, let's talk about some of the things that make me think we might be headed up. This is a chart that I've been following for probably the last 3 weeks now. It's a comparison on how our market now in 2025 is behaving compared to how it behaved in 1998. And what happened in 1998, and the situations are different, but it doesn't mean that history will repeat itself, but there are rhymes. You can see a behavior that may be similar. And so what happened in 1998 is that the market went down, it hit a bottom, it went up, hit this area of resistance where people had missed the last sell-off, decided to sell, they sold again. And then what happened was when it tested the same bottom across here, people said, you know what? It's not going to be bad. We're going to go ahead and we're going to get back in the market again. You know what? They did. And they got in, and we have this kind of return. Right now, I thought we were going to be here, but because of President Trump's announcements yesterday, it went up and it's actually retested these highs. This is the new resistance level right now. And today, watched, and the market really was kind of flat. It wasn't bull or bear, more kangaroo, but it's holding. And I'm curious to see, is it going to be a V-shaped recovery and take off again? Or is it going to come back down here, test the lows, and then take off then? And to tell you that, oh, well, you know, if it does one thing, we know exactly what it's going to do. No, the information, the news, the rumors, the facts, all those pieces can change this discussion like that. And so consequently, we want to make sure that we're watching all of it, the technicals, the fundamentals, the rumors, the news, the facts, to decide where this is going to go. Right now, yesterday, it was a fantastic day. And I hope it holds, and I hope everything takes off. I hope that over the next few weeks that the Trump administration comes out with many new trade deals and worked out with those partners, especially the ones in the red that you saw a moment ago for tariffs. I hope that comes out and we get a trade balance that will just make it so we can take off and do well. I hope that the tax bill that is being talked about comes out and we see the tax situation for many middle-class Americans, their taxes go down. I think that's going to be fantastic for the economy. But along the way, there could be news and rumors that come out and things like that that will change that discussion. So I'm telling you that right now, I think this is not a bad chart to look at, but only time will tell what we have to deal with. And so that's why we stay on top of it, and I know that's why you do as well. Interestingly enough, that at this top piece, and I debated whether I was going to put this slide or not, because after what happened yesterday, it changed this. But when this hit this top in 1998, it was a very thin. The market went really high, but didn't close there. It went low. It started out low, didn't close there. Had very little reaction in here for the long term, and stuck. We had that happen last Friday. Same thing happened last Friday, which made me think this is what we're looking at. Another test the bottom again and then take off. Don't know. Again, I didn't expect President Trump to come out and share such great information. And on a side note, when he shared the information about the drug companies and how Americans pay 3 and 4 times for their drugs what the rest of the world does, and how that's going to be something that's going to be changed in the next 3, 6, 12 months, my goodness, you imagine what that's going to do if you have extra money that you were spending on drugs or pharmaceuticals you need to help with health issues for you and your family, and that cuts down. It's like those prices reduce. Just imagine what that's going to mean for the economy. Here's another thing. This is another positive in my mind. Companies buy back their stock. You may not realize that, but companies buy back their stock. They have stock out there. They see it. They buy it back. They put it in their treasury, and then somewhere down the road, they need capital. They sell it out again. They sell it to other investors. You may or may not realize that's what's happening, but notice here on this chart, in 2025, there are more companies buying back their stock right now than any time in the past since 2013. That's amazing. And if you stop and think about it for a second, companies are only going to buy back their stock for one reason, because they think it's a good investment. They feel like this is a great opportunity. They're going to capitalize on the fact that the share prices are low, bring that in, those share prices go up 10, 15, 20, 30%. They now have more capital to work with because they bought them at lower prices. So companies buying back stock, which is not the same thing as institutional investors. This is just companies doing their own buyback of stock. That's a good thing. That's a positive in my mind. Also, earnings per share. Expectations versus where we are in this quarter here. Earnings per share growth continues to meet expectations and exceed it. We were anticipating for Q2 in this month here, 6%. So far, we're tracking at 12%. So that means companies are still being profitable. That's also a very positive thing. Now, to be fair, there might be some front loading going on. There might be some people that said, you know what, I'm concerned that I might not be able to buy the thing that I want on the shelves because it might be out, or if the tariffs are so bad that it's higher in price. I want to buy it now. So there might be some front loading on that as well. Maybe people are buying cars now because they're afraid they can't get them in 3 months at a reasonable price. So that kind of thing is out there working with us and against us. However, if it turns out the tariff prices aren't that high, it's going to be fine then too. But we'll see. Companies are still profitable, and that's important in this discussion from my viewpoint. And earnings season, I just kind of showed you that. This week, these are some of the major companies that come out with information. I get this every week. There's just, loads and loads of companies. Remember, S&P 500, Russell 2000, there's loads of companies coming out with their earnings report. And they've had, across the board, very good reports. Very good reports. Some have had bad reports, no doubt, but many of them have been good, and that's also a strength. And then finally, just this one thing here, I've been referencing it the whole time. When President Trump came out yesterday and said it was yesterday. Very good meeting today with China and Switzerland. I guess it's 2 days ago now. Many things discussed, much agreed to, a total reset negotiated in a friendly but constructive manner. We want to see, for the good of both China and the U.S., an opening up of China to American business. Great progress made. And one of the things I was looking for off this was, what did China say? Did China come out and say, we don't know any of this? But they didn't. They came out and they said, yeah, it was a good conversation. We are going to work with this. And that by itself lends a great strength to the fact that this may not be so bad as we work through these next few months and roughly 70 countries coming to the table with the U.S. to create fair trade balance. That's a good thing. So all of this together links with what I've been sharing with you before multiple times. What we do is we do fundamental analytics. What is the strength of the economy? What's the strength of an industry we're looking at? What's the strength of securities we're looking at? Fundamentally, are they good? And if we think they're good, technical analytics come in where we say, okay, we think they're good, but would we buy them today? Because even if they're a strong company, but they're just on the outside because of the way the sector rotation works, we might say, not right now, but let's keep them in our list, a watch list to come back somewhere down the road when the analytics, the technicals show that. And then, to be fair, it's behavioral analytics. The stock market is a war every day. It's a war between buyers and sellers. Buyers are pushing the market up, sellers are pushing it down. Some days the buyers win, some days the sellers win. And that behavioral analytics has a lot to do with this. So understanding people's reactions to information and trying to at least stay on top of all that is just a critical component of managing wealth wisely. And so that's why we call it the 3D trading strategy, but it's really just trying to think through each piece and utilize the best opportunities to help clients grow wealth and keep wealth. So with that, we can take a look at the markets. I could show you, and let me see what the time is here. Oh, we're doing good. So I can take a look here and show you how the S&P 500, which is what you're seeing here, is doing. You can see we've had a very nice run up, broke through this resistance. It's very nice up here. Think that it's very possible that if the good news keeps coming and if there is not any bad news, and I think in next month, one of the things I decided not to talk about this time, but I really do think it's worth talking about, is that there are bull market cycles that have bear markets in them, meaning that it's going up and up and up, but it has a bear that happens in it. You saw that in the Trump presidency 1.0 slide I showed you. And then there are bear markets that have bull market rallies. And so those pieces come together here. So I think that we're about to find out if we're going to continue this bull market cycle with a bear here and there, or are we actually going to change and have something else happen? If it's the good news, which is what I'm hoping for, even if we have a reset, even if we go up and then we retest that low that happened about 2 weeks ago or 3 weeks ago, and then we take off again, I think that's a very strong sign. I would welcome that, to be honest with you. But if we just keep going, it's a V-shaped recovery, that's fine too, because I think our next area here would be about 6150 on the S&P 500. And I was just reading some reports today that several groups are coming out and saying they think it's possible that we'd be looking at an S&P of 6500. So that would be very good too. So we're watching these pieces right now, and I would tell you that I'm hopeful, more so than I was when I did this review last month, that we're going to see some things come together. And again, if you have questions on this, feel free to ask. I'm here for you. We're here for you. Our team is. As always, we have a modeling that we're using with our portfolio allocation management. We're constantly tracking various pieces that we like, income investments, growth investments, individual equities, or ETFs, also looking at certain types of pooled real estate or pooled private equity for certain types of clients. These are all pieces that are out there in our mixture that we work with to help clients invest. And that's all part of how we pull these various portfolios together, because all 8 of these circles we help clients with. We help clients with cash reserve accounts. We help clients with bonds or debt instruments. We help clients with equities or stocks. We help them with real estate, whether it's pooled in big groups or specialty programs. We help them with tangible assets like energy, metals, commodities. We help them with currency, the U.S. dollar. Right now, the U.S. dollar is strengthening. However, just the last few weeks, it went down, trying to determine, is this time to buy into a strengthening dollar? And if so, how will we make that work for clients? And so that's one of the things we were looking at here even today. Business interests, private business interests, where you can't invest them in the public markets, but you can do them through private equity programs. And then finally, insurance and annuities, which can give you mixtures of these various circles, but with protections for loss of income or loss of capital, to make it so that you can invest more aggressively without the fear that you might have a loss that you can't come back from. We strive to be client-driven and advisor-managed. And what that means is we try to hear what our clients are telling us they want, and then we try to help bring about that result for them, whether it is investments, risk management like insurance or tax issues, or financial planning. And I would say to you that I am convinced that financial planning is really honestly the most important piece of this discussion. Yes, you want us to grow money. Yes, you want to figure out where's the best place to be now and how do we protect against loss on other investments. Clearly, that's critical. Return on investment, return on equity, obviously very critical. But when it comes to having that long view and not FOMO, fear of missing out, or fear of losing money, when it comes to having a longer view, having a financial plan that shows you if you're on the right track or not is critical. Because once you know how much you have to make it so you can meet your needs, chasing a very high, unrealistic return is no longer a problem. If you knew for sure that you could meet all your life goals with life and planning and living out and doing the things you want to do, your bucket list and so on, and just all you had to do was make 6% on your money. If you knew that was the case, you wouldn't have to chase higher rates of return. You might do it because you think, well, I've got a great opportunity here, but you wouldn't have to chase it. You wouldn't operate with that pressure. And that's why I think financial planning helps you navigate the upside of the mountain where you're pre-retirement, you're accumulating and accumulating and accumulating, or the post-retirement decumulation phase where you're pulling money out of your accounts and you're living life. And then having something left over, if that's important to you, to transfer to your loved ones. That's what having a good financial plan can do. It can help you decide, what retirement curve am I facing? Do I have a red curve that runs out of money before I run out of life? Do I have a green curve that's runaway that just keeps going and I keep growing more wealth and growing more wealth? Maybe I could enjoy a few more things or do a few more things or accomplish some goals that I thought were really important that I've missed because my green curve is just off the charts. Or helping you create a purple curve, a good curve that meets all your needs, both in good times and in bad times. Because having an ideal financial plan, a most likely realistic scenario, is only half the equation. We call that your baseline. But when we take a look at a client with their income gap and their wealth gap, whether it's positive or negative, and then help them decide what to do next, then once we have that all figured out with that baseline plan, we can then help them stress test it. This is what it looks like, a plus or minus wealth or income gap during their ideal retirement. But what about if they have a less than ideal retirement? What about that? Are we still good? Do they have enough resources? What if they have a disability or long-term care need? Will they still be fine? What if one spouse passes away prematurely? Will they still be okay? When you have those answers in place and you know what rates of return you have to make on your money to make that happen, that really takes a lot of the pressure off. And that's why we try to help clients put together a financial plan and then put all of this in support of it. Think of it like a three-legged stool. You have a financial plan that tells you what you need. You have an investment strategy that meets your financial planning goals, and you have a risk management strategy to protect against loss of capital, loss of income, tax strategies, etc., to protect against the negative things that can happen in life. Having that three-legged stool makes it so you can confidently invest and not have to chase the whims or, again, FOMO, fear of missing out, or fear of losing money. You don't have to have those. You have a plan in place to minimize that and to work with that. To that point, we provide clients doing financial planning with their IXL financial dashboard. This is a fake couple, Harry and Mary Arm, from a joke got a long time ago, Harry Arm. I don't know if you picked up on that or not. But anyway, Harry and Mary Arm, it's designed to identify net worth, their investment strategies, their income, and their outgo. Because here's the big secret. Your financial planning life, it's based on this mathematical model. Your income minus your outgo against what you own and what you owe. If your income is more than your outgo, you're good. If your income is less than your outgo, you might have to pull from what you own to make that work. Or you might have to pull from what you owe to increase, to borrow more money to get by. That model is what this is designed to help clients understand so they can make good decisions and have confidence as they move forward. To that point, we provide 4 different applications to clients as part of the planning process. 1 is their financial dashboard, which I just showed you what that looks like. 2 is their portfolio dashboard, so they can see performance numbers on the money that we're managing directly for them. 3 is a risk reward assessment tool that helps clients understand how much risk tolerance they can accept. 1 to 99. 99 means they're a full-on risk taker. 1 means they're a full-on risk avoider. And then this ties it all together, your financial life plan. Because these are all the facts and figures, but what we really want to do is help people to match their feelings and desires to the facts and figures of their situation, to create their life goal, or what you might call a bucket list, or have life transitions figured out ahead of time. So if you have children going to college, or parents that are older that might need your assistance, having those plans figured out are another part of that planning process. So as I said a moment ago, we're going to open up for questions if you have any. You can either raise your hand, and if I can see your hand, I'll either look for your chat, or if we can unmute you, I'll let you talk and we can just actually talk it out a bit. So we'll talk about that in a second. One other piece, if you can't get your question out, or we get finished with this once it's concluded and you say, I did have another question, just email Megan at our office, and Megan will get those questions to me. Myself or one of our staff will get back with you for the questions, or maybe I'll even make it part of our next Wealth Advisory Review. So our next Financial Advisory Review is going to be on June 10th. And during that time, depending on what happens, if the markets are really good, we'll talk about one thing. If the market's really bad, we'll talk about another thing. But also, we'll be talking about analysis and expectations, fundamentals, sentiment analysis if necessary, planning, and strategies to help you make the most of what you have, how to create, grow, protect, and preserve family wealth for you and future generations, and then take time for your questions as well. So here's what we covered tonight. The Trump presidencies 1.0 and 2.0, reasons why the markets may fall further, sector rotation and portfolio management. We also looked at reasons why the market might have a V-shaped recovery and take off again. We talked about bad markets and economies and how that makes planning, financial planning, essential to help bring about that stability. That the reality is this: the only thing certain is uncertainty. That's it. So having a plan in place helps you to make sense of what's going on around you. Maybe easiest to think of it like this: if you were going to take a month-long vacation, you might do some planning. You might actually plan ahead where you're going to stay, where you're going to drive, what you're going to do, where you're going to eat. You might plan some of those things. Why? Because you want to have an enjoyable trip. Well, if you would do that for a 1 week or 2 week or 4 week vacation, should you do that for your entire life? That's why we provide all these amazing tools and applications to make it so you can do that as easily as possible. The difference, what we try to bring to clients, is to be client-driven, identify what you're going for, and then advisor-managed, helping you achieve it. I'll come back around to questions in a second. I've already shared with you about the next review. If you would like to invite your friends to our monthly updates, you are more than welcome to do so. Just let Megan know, and she'll send them an invite. We will not follow up with them. I mean, for those of you who had that happen to you, you realize we don't call you and chase you down. If you want to talk, we'd love to talk to you. If you don't, you got somebody else you're working with, fantastic. Make the most of it, because that's all this is about. And so if you do want somebody to be invited to this, just email Megan at megan@franksoffice.com. But I will tell you that every time I finish up here, I would say maybe once every 4 or 5 meetings, I get somebody has questions. And I figure either A, I have just confused you so much you don't know what to ask, or B, I've got everything across to you that you needed and you don't have any additional information or request needs. So I'm going to assume it's the second, not the first. But again, if it is the first, please let me know, because I want to make sure these are valuable for you. That's the whole purpose of this. All right. Okay, the question is, let me just make sure it's not bigger than that. It's just that whole thing there. Yeah. Why are the extremely wealthy buying physical gold? If you followed gold for the last probably 6 months, it has been growing because a lot of central banks are buying gold. A lot of this has to do with BRICS, which is China and Russia, Brazil, India. They're creating this currency to compete with the US dollar. And so they're buying gold because their economies are not such that they can compete with the US engine, the economic engine that we are. That's part of it. And so then, because that's driving the price of gold up, physical gold, that has caused other investors to decide to buy that as well. Gold is a very interesting asset. I like it, and at times we've held it in our portfolios. But it's an asset that seems to engender this thought that either you have to buy it and you can never sell it. Rarely do people think about buying it and then selling it at times. As a matter of fact, let's just say the economy takes off right now. Gold hit a near high. It hit actually an all-time high recently, but it's already started to come off that high. If the stock market takes off, chances are gold will come back down again. So at that point, if it comes back down far enough, I would say it'd be a great asset to buy in the portfolio. However, some people say, no, I don't want it in my portfolio. I want it at my house. Okay, great. Then you can buy the physical gold. We actually have ETFs that buy physical gold, and we have ETFs that do the securities themselves. So we can talk about that, but that has a lot to do with it. That's a good question, Jeff. They're buying it because it's sort of being led by international groups that are trying to shore up a big opportunity to compete with the dollar on the global trading market. And so investors are seeing that, and especially those that are very interested in gold, they are drawn to that. So my problem with gold, quite honestly, and I like it. I don't think it was a bad asset. Matter of fact, I think it's a great asset. It doesn't pay any interest, and it doesn't have anything technically that will make it go up in value other than fear, inflation, fear of war, things like that. And so it's not like you can take that asset and invest in it and then hold it for a long period of time, because you won't get any income off of it, and you'll be waiting for some catastrophic event to happen to make that work. That's why it's gone up so much lately, is because of the fears of recession. If I haven't made it clear yet, the last recession, well, we had a recession along the way, but the last great reset was 2008. And it's very likely we're going to experience another reset sooner or later for some particular reason. It could be currency, it could be debt, it could be this U.S. Treasury thing I was talking about. There are various reasons. And then all the printing of money that happened from the pandemic until last year or so, all of that created a recession that is also going to create some cyclical problems that have to be dealt with. So that's why. And I think that it may be an asset that has been in favor. If the economy gets worse, we'll be in favor still. And if the economy gets better, it won't be in favor for a while. Hopefully that gives a good answer for that. And thank you for asking. All right, I don't see any other questions. So with that, I'm going to head out and tell you God bless, and I look forward to talking to you all soon. And if you have any questions or any needs or anything, please give us a call. We're right here for you anytime. Good night.